Our next story revolves around the Lycra company, the well-known producer of Spandex fiber, which has filed for Chapter 11 bankruptcy in Texas as part of a major financial restructuring. Just to break this down, Spandex, of course, has become a part of every household in a way. It's an essential in modern apparel, from sportswear, swimwear, undergarments, lingerie, socks, even medical stockings, bandages. It's stretch, it's flexibility, making it a global textile staple. And this move is not about shutting down the business. It's a strategic step to reduce its massive debt burden and stabilize operations. Under the plan, the company will wipe out approximately $1.2 billion in long-term debt. And in addition, it will receive over $75 million in fresh capital to keep the business running smoothly during and after the process. The company has stated that this restructuring will not impact its customers, suppliers, or its 2,000 employees. Day-to-day operations are expected to continue without disruption. This bankruptcy filing also marking the culmination of years of financial struggles. The company's roots dating back to 1958, when scientists first invented Spandex. And in recent years, Lycra has faced repeated setbacks, the latest one being their second in the last 5 years. In 2022, lenders already seized ownership after defaults under its previous owner, which was a Chinese conglomerate. The COVID-19 pandemic disrupted supply chains, reduced consumer demand. Even after the pandemic, in fact, high inflation and intense competition from lower-cost manufacturers weighed heavily on the company, reportedly. And by the end of last year, these issues had significantly impacted operations. Factories were running at only about 60% capacity. Profits were expected to fall sharply from $132 million in 2024 to just $44 million. The company also had a complex and heavy debt structure, which includes hundreds of millions in loans and both euro and dollar denominated bonds. Earlier, attempts to fix its finances, including a plan in 2025 to sell the company and repay all debt, but it fell through when the deal collapsed. And as the conditions worsened, creditors stepped in with a plan B to take control. Even that plan had to be reworked as the company's financial health continued to decline. And after months of negotiations, the current restructuring deal was finalized and formally filed